So how I came to meet Barry and Greybrook was I heard whispers for years from other realtors that I know, and this group of realtors is all very successful. So there's the saying success leaves clues. So I was asking questions and so on, and I ended up meeting the president of Greybrook. Chris is his name. I met him at a private event. And he told me about how it works. And I was really, really enthusiastic at that point. I was kind of like emailing him every week. Hey, can I talk to someone? Can I get a webinar started? And the nice thing about what we do is that we've got a large group of people that we can reach really quickly, whether it's through social media or past clients or Milton Daily Homes or Sold Watch, which is probably how you guys heard about it. I thought I really want to learn more. So I'm bringing you guys along on the journey with me of just learning more about how Greybrook works. And I think it's a really interesting model that fits really well. Like I just bought an investment property in Calgary, and it's like any investment property, you're putting 20% down, right? Plus closing costs. So I bought this place in Calgary for $400,000, but that's still $90,000 I've got to commit to it, right? So never mind if you buy anything in the GTA, it's even more than that. You're well into the six figures. So the barrier to entry is lower. I like the idea of the RRSPs. The returns sound amazing. And then no tenants, because I know with investors, that's a big reason why they don't want to get involved with real estate investing, is because just the tenant headaches and everything else. I'll let them remain anonymous, but I've got clients in this chat that just went through hell with some tenants, and they'll know what I'm talking about. But that's basically it. So Barry and I connected. We had a chat. How long ago, Barry? Maybe like a month or two ago?
Yeah, sounds about right. I can't believe we're already into May, but yeah.
Trying to coordinate all of our schedules can be certainly a challenge. So we this was the first chance we had to get things set up. So yeah, I guess I'd like to formally introduce Barry McCullough, who is the vice president of Greybrook's Private Capital Markets Group. And you were going to take us along on a journey, and we'll try and make it very conversational and, just have it just kind of flow. You've got a couple of slides that you can share.
For sure.
But the floor is yours. We've got a couple of questions in the chat, so I'll read them and then I'll just start kind of being, I'll start the conversation when I feel the place is right to put those questions in.
Of course.
But I'll let you go ahead.
All right, so I'll just share my screen here so everybody can take a peek. So yeah, certainly check if as there's questions that come in, sort of throw them my way, and we can kind of go through those. There's probably about 27 or 28 slides in here. I think we'll try to keep it, somewhat brief and on topic here. I'll obviously skip the legal disclaimer that our roster of lawyers insists on being in there. And for those that are curious about getting a copy of this presentation as well, I mentioned it to Chuck. You can always reach out to Chuck or myself offline, and we can share a copy of the presentation so you can kind of flip through it at your own time as well. But let's talk a little bit about Greybrook. So Greybrook's, I guess, next year will mark our 20th year in business. So we really started off, initially investing in our backyard in sort of Toronto, in the Greater Toronto area. Our portfolio has kind of grown over the past 2 decades to over 100 different real estate investments. Again, predominantly in the sort of core Toronto, 905 sort of Greater Golden Horseshoe area. Also a growing portfolio in the US as well that we'll talk about in a few minutes. Collectively, we've raised over about $2 billion from institutional and private investors in our history so far. We took a look at our portfolio of different projects. It really kind of cumulatively represents about $30 billion in completion value. So if you're to look at sort of the total sellout value of our whole portfolio, whether it's townhomes, high-rise condos, multifamily apartment buildings, it's north of about 30 billion, about 60 million square feet of density. And I think this 8,000 number is maybe a little bit outdated. I think we're close to about 10,000 now, but we've really kind of grown over many years, just initially investing the firm's capital in the early days until we were really comfortable with the strategy and the execution. Then from there, sort of opening it up to friends and family investing alongside, and then to our current sort of iteration where we're a registered exempt market dealer, registered in Ontario and all the other provinces in the US as well. And we're working with, again, almost 10,000 investors from Canada, the US, and about 30 other countries. So really, I'll take a step back. What Greybrook is, as sort of Chuck mentioned, is we're a private equity firm that has a specific focus on real estate development, specifically residential real estate. And that can really encompass, any flavor, so to speak, whether it's ground-related housing, townhomes, single-family detached homes, up through kind of mid-rise and high-rise condos, purpose-built rental developments, which we'll typically focus on certain in U.S. markets. And really, our goal is we'll raise capital on a per project basis. So it's not a fund where investors would, allocate, a portion of their portfolio towards. Rather, you would pick and choose on a per project basis, which developments that you want to take part in, depending on their projected timeline, the geographic market, what the project type is, who our developer partner is. And really, my goal and my team's goal is to work with our investors and help them build a bit of a diversified portfolio. So for a typical investor, Greybrook might represent, 5, 10, maybe 20% of their total financial assets as a household, but still within that sort of bucket of capital. Our goal is to get that, diversified across product type, timeline, geography. Same reason that you wouldn't own just one stock. From our perspective, obviously diversification is a key focus as well. Typically in our projects, they'll generally last about 4 to 7 years on average. Some can be a bit shorter, some can be a bit longer, but our typical return target is about a 20% sort of average annual return. Bear in mind that it's not a investment that's paying dividends or cash flow monthly or quarterly. It's rather more of a longer term kind of capital growth strategy where at the completion of a project, when home closings are taking place, that's really when we're capturing the balance of our revenues and profits as a development group, and that's when we're then in a position to share that profits with our investors as well. So I think you had a question off the top earlier, Chuck, about sort of dividends and timing. Just to sort of clarify, it's more of a medium term to long term capital growth strategy that we target. As I mentioned, our portfolio.
Can I step in, Barry?
Yeah, of course.
One of the biggest success stories I heard was in excess of 70% return. So the story that I heard about that was that you got to the point where the approvals were there, the permits were all set to build, and then you looked and said, if we build, it's going to take this much time. It's actually probably going to lower the returns. So the yield at the end wouldn't even be as good as this point if we sold it off. So, it can move a bit, right? Like depending on strategically, if it makes sense to exit, then you might decide that the timeline can change.
For sure, that's a great point, and really that's kind of hits on why we structure ourselves purposely as equity, as essentially owners of a project rather than investing in a way through lending or as a creditor. And there are strategies that do that, but from our perspective, it's not a accidental decision to approach it from this. It's because it puts you in the driver's seat to make those type of decisions, as you mentioned, Chuck. So as we go through a project, and we'll touch a little bit on certain things, but typically you can kind of divide a project into 3 buckets or 3 stages. You have your planning and approval stage, where you work with the city or the municipality to get all of your requisite zoning and approvals in hand. Once that's done, you'll go into your pre-construction sales, whether it's a condo project, a townhome development, whatnot. And then once you reach a certain pre-sales threshold, then you'll get into the actual hard construction and in final delivery. But at each of those different inflection points and milestones. So as we go through the planning process, we might have bought land as an example that was properly entitled for residential use, but would have to go through multi-year planning timeline. Let's say for $1 million in acres, to use round numbers in the GTA, those lands, when they're fully zoned and approved, could be worth 2 times or 3 times that amount, right? So it's always a decision that we make and say, do we look to actually just sell the lands now, can we outperform our return targets? Can we shorten the timeline? Can we take risk off the table? Or is it more profitable, taking those things into account, to continue and build and sell townhomes or condo development, whatever the project type is? So as you mentioned, Chuck, there were a number of times in our history where we've made sort of tactical decisions to exit a project early. Often that means kind of selling it upon achieving certain approvals, and that's usually where we're able to materially outperform the annual targets, take risk off the table, shorten timelines, and whatnot. So it's a great question.
Great.
So I'll just sort of, again, touching on the portfolio, like I said, we're focused, predominantly in Canada and the US. In Canada, our really focus is sort of Toronto and the Greater Golden Horseshoe. In those markets, we'll do anything from, like I said, low-rise ground-related housing, any kind of condo product, which is typically in kind of the 416 or core Toronto area. And in the US, we have a bit of a dual focus on one hand on the luxury or ultra luxury condo developments. We're in the midst of developing the Waldorf Astoria hotel and residences in Miami. It's going to be about 1,050 feet tall, 100 stories. Broken ground there late last year, and when it's all finished, it'll be the first super tall tower in Miami, and the tallest tower on the eastern seaboard south of Manhattan. So I guess when we entered the US, decided to do it with a bit of a splash, but the other focus on that is also on the multifamily rental developments, and we've done acquisitions and have projects underway in Denver and Nashville, Fort Lauderdale, Atlanta, and so forth. So as I mentioned earlier, just geography and geographic market is just another way for our investors to diversify their investments with us. Our approach can really sort of distill it down to a few kind of key criteria. I mean, it really starts with picking your markets, right, and focusing on those that have the strongest fundamentals. I had the question sometimes, why don't we develop in Calgary or Edmonton or Vancouver? All large markets by any measure in Canada, but really it comes down to, if we look at in Canada, where's the best or the strongest long-term supply-demand fundamentals? You have, a real sort of industry that's running at full capacity. You have, constraints as to where you can expand with a green belt that envelops the region, and you have steady and persistent demand in terms of population growth. So that really sort of informs our top-down macro view when it comes to market selection, obviously in Canada, and those similar attributes in these metros in the US. A sophisticated acquisitions capability comes down to the fact that Greybrook is not simply a capital raiser, right? We're not interested in just providing financing for a developer. We're actually co-managing these projects along with our developer partners, and that means that we have sort of the internal talent and knowledge to underwrite these developments independent of our partners. So we'll take a look at, the planning risk involved, what we think in terms of absorption for sales and costs and revenues. We'll typically maybe pull the trigger on 5 to 8% of projects that we'll see in our pipeline in a given year. And really our asset management team is essentially comprised of individuals that used to work at low-rise developers, high-rise developers, municipal planning specialists. So there's really the engine, so to speak, within Greybrook to look at acquisitions through a very sophisticated lens. And then from the point of acquiring a site, it's not simply a matter of just saying, here you go, Tribute Communities, here's $30 million. Let us know how it goes in 5 years. Rather, like I said, it's a co-management from start to finish. So when it comes to questions about more immaterial decisions in a project, we kind of give full latitude for our partners on those. But if it's decisions in terms of sales and marketing strategy, price list when we go to launch sales, what kind of term sheets we'll look at for construction loans, anything that could have an economic impact on the project and the profitability to our investors, we sort of make those jointly with our developers. And like I mentioned, the developers that we work with are all best in breed. So for those that are from Milton or from Toronto in the area, you might recognize some of the names that I'll show you in a minute, but it's really developers that have been around for decades in many cases. They're not doing their first or second housing development. It's probably their 31st or 32nd for most of these organizations. So really it's critical to partner with top tier developers that have that management experience, have that track record, have those banking relationships to really do the utmost to ensure success in a project. Sorry, just have
Is that frozen?
It's frozen there for a second. Of course, it decides.
Okay, well, while Barry's figuring that out, do we have any questions in the chat? There was a question, I believe it was, let's see here, Maddie, and so they say, I've previously used my RRSP for purchase of my first home over 2 decades ago, but this has been repaid. So that essentially is like a closed thing. I'm wondering what my federal tax implications would be in using my RRSP for this type of investment. So tax implications for using RRSP. And I know you'll probably get to that a bit later. Do you want to
Sure.
handle that now or in a bit?
Yeah. Simply with an RRSP investment, it's really no different than any other, investment that you would have in an RRSP. In that the growth or the investment growth would be tax free. Obviously, at some point down the road, when you withdraw from the RRSP, you'll have to pay taxes when you start withdrawing. But in terms of sheltering the gains from tax, RRSPs or other kind of registered plans like a TFSA are really ideally suited, right? Because you're avoiding what could be a pretty consequential tax bite.
Question in the chat that lines up with what you're just talking about. Can I use my TFSA to do this investment?
You can, yeah. So any sort of registered plan, whether it's TFSA, LIRAs, RSPs, RESPs even. I mean, with an RESP, obviously be mindful of timelines and when you might need those funds for education purposes. But our team can really assist you with getting those registered accounts set up, whether you're making new contributions or transfers and whatnot. We can help assist with all that.
Good. So your slides are working now?
I think so. Fingers crossed.
All right.
So really, this sort of drills down a bit more in terms of our thesis. I'll just quickly, again, I sort of feel like I touched on these buckets already, but you can kind of segment our products or projects into four broad categories. For sale residential development will really include anything that's, as the name implies, being sold to an end user, low-rise homes, townhomes, condos, and whatnot. The multifamily U.S. projects, again, bit of a different, still a development project, but the asset type, the sort of order of operations is a bit different. There is no sales program. We would build the building, lease it up, and then sell it in one transaction to an institutional purchaser. We've sort of broken out land development as its own category. And by that, what we're referring to is projects where we don't actually have a plan to go through a full build cycle, but rather just go through that planning process, take it through a draft plan or to a serviced lot stage, and then sell that to another developer as essentially a turnkey ready site. And then residential value add, it's a bit of a smaller part of our portfolio, but I'll touch on it later, where it's really just sort of buying assets that are more existing mid-rise or high-rise apartments, sort of these garden style townhomes that we see in US markets, and taking them through a bit of a repositioning process where you'll upgrade the suites as people will move out and you have kind of natural turnover, really invest in these underinvested assets, grow the income for the portfolio over a number of years, and then sell that and generate a capital gain to our investors. Oftentimes, there's also a bit of a yield with this strategy as well, given that it is an existing cash flowing asset. But that's sort of generally the four kind of categories that our projects can fall into. As I mentioned before, the partners that we work with are all ones that are best in breed. Some of these names might be familiar to those from the GTA market. PMG is our partner in the US Property Markets Group. They're the ones that we're doing the Waldorf Astoria with in Miami and a few other projects. So won't dwell too much on this. I feel like I've sort of touched on it, but feel free to look into any of these firms. They're all top notch. Investing in Southern Ontario, like I said, it's really our backyard and where our core focus is insofar as our Canadian portfolio. Just a few projects, a few sort of renderings of things that we have that are finished or under development. Probably a bit of information that a lot of you in this webinar would already know, but as I mentioned, it's really looking at the fundamentals of Toronto compared to other major markets. And it's no surprise to anybody that a lot of this is driven by just growth, in population at a federal level in the country. I think probably people would have heard that there was 1 million plus, population growth last year, and probably on pace for what I would say is probably 500,000 average per year, given where the immigration targets are and so forth. And that rate really far eclipses anything that you see in other G7 nations, much faster than the growth rate in the US and other European nations. Quality of life, I think we've always ranked among the top or the top 5 in other countries. So it's really, you can see why there's a strong and steady demand and sort of increase in population. And we'll talk a little bit about sort of the supply challenges as well. So it's one thing to have demand, but you also have to look at, if you had the ability to provide endless supply, well, the demand doesn't really matter so much. But when you have a strong and persistent demand coupled with what I'll call is a multifaceted supply challenge to solve. You can see why pricing in the Toronto market has been for a very long time pretty resilient, and in our opinion is going to continue to be pretty resilient for years to come. Again, those that are from the area would be very well versed with the green belt and how that actually prohibits any development in those green shaded areas. The gray area really signifies areas where there are already built up existing communities. So you really have these little pockets of, I guess it would be light yellow, that show what are called white belt lands. These are lands that are outside the urban boundary, but not in the green belt. So basically to be developed at some point in the future. So there's really, if you were just take a satellite view of Ontario, it looks like there's endless supply of land. In reality, from a zoning and a planning perspective, not so much. Setting that aside, you obviously have, true restrictions in terms of industry capacity, right? So there's only so many cranes, so many trades and underway at any one time. So even if you were to sort of wave a magic wand and make every land all of a sudden approved, the question then becomes, where do you find the labor and the capital to build those with an industry that's already running flat out? So all that to say is that it's, in the near term and probably in the medium term, it's not a very easy to solve supply situation. I think for the first time in many years, we see a provincial government that's actually shining the spotlight appropriately on what the actual challenge is and what will be a good way to kind of solve affordability in the coming years. So fingers crossed that we see some positive progress on that front, whether it's expanding the enrollment in skilled trades or streamlining red tape in terms of approvals. But really, this again is underpins our supply side of our thesis here.
Yeah, often when governments intervene, it tends to do the opposite of what they're hoping to do, right?
Yeah.
So really what you're saying is you believe that the market for the GTA, Milton, Toronto, so on, is going to remain strong, because that's something that we're constantly telling people. They can't believe that prices can go much higher. And it's like, well, yeah, they probably will, right?
Yeah, I mean, I think you're going to see, as the slide kind of shows here, really you'll have peaks and valleys as you go along the way. But if you're investing, and again, we're not investing with a 1 or 2 year horizon in mind, but a multi-year outlook on the market and in our project. So you can see you'll have peaks and valleys as you go. You had a run up in 2017, and that was cooled off with different intervention from provincial policy with the Fair Housing Plan. You had the mortgage stress test that OSFI enacted in 2018. And then you had what obviously a lot of us saw in 2021, where you had a strong run up in pricing sort of post-COVID. And I think what you saw there was really a pull forward of demand, right? You probably have people who were going to buy maybe in 2022 or this year that saw rates go to zero essentially and said, okay, here's my chance to jump into the market. So I think that's really, in our view, a bit of an artificial peak. We're never a firm that would look at that and say, hey, let's assume that prices are going to go up 20% forever and base our modeling and our forecasts on that. When we look at a project and we model out, our assumptions in a development that might be 4 or 5 years away from sales, we'll typically forecast either really no growth or maybe a nominal sort of inflationary amount of growth. It's in this chart here, this slide is really just aimed to show that there's dozens of different policy interventions from different, whether it's the banking regulators, whether it's provincial or federal levels of government, to try to rein in the market. They'll have effects at certain points in time, but the long-term outlook, the long-term trend is still, until you either turn off demand or really solve supply in a significant way, you're going to have these peaks and valleys. But the long-term trend is in our opinion pretty intact.
Question in the chat. There's actually two. So the first one is, what banks does Greybrook deal with? And obviously we've heard some issues with US banks, and I know that you're involved south of the border. And then the second question is, how are the profits taxed? So when somebody comes in as an investor, is it capital gains?
Sure. So I would assume what banks is sort of looking at which banks do we use in terms of our construction financing and
Correct.
Part of our developments. Okay. So we have relationships with, I would say, all the big 5 banks. So typically, from our perspective, I would say, including Desjardins as well, not to leave them out of it. So really into the larger institutions, and sometimes too, you'll have multiple banks that will be involved in a construction project, because they'll typically have risk limits. Let's say if it's a a luxury condo that we're doing in Yorkville that might be a $250 million construction budget. Any of those banks might have a max at, let's say, 50 or 75 million. So you'll have 2, 3, maybe 4 banks in a syndicate for a large project, but they would all be tier 1 banks that I'm sure most of us in this chat are banking with today.
Now, when you go south of the border, do you still deal with Canadian banks, or do you go with some of the U.S. institutions?
U.S. institutions primarily. I think whether that changes in the coming years, I guess we'll see. There's a little bit of regional banks going through a bit of a difficult period right now. I'll tell you, in our Fort Lauderdale project that we did, I think we had Goldman Sachs as the lender on that. Can't recall top of mind who else we had with our other society products, but they would all be sort of similar larger institutions. It's not your smaller kind of community banks.
Okay. And then how are would it be a capital gain? I mean, obviously, if it's within the RRSP, it's a different type of taxation, but it's basically whatever module you use, it's going to be taxed appropriately. Yeah.
So if it's an RRSP, TFSA, or sort of similar registered account, tax again is not really a concern. There is no tax on the growth. Those that would be investing with non-registered funds. So if you're doing it, in a personal name or through a corporation, it really comes down to the type of asset that we're doing. So to kind of generalize, if we're doing a multifamily asset, right, where we can build basically a rental building or acquire a rental building, those are treated as capital gains. If we're doing a project where it's for sale to an end user, so a condo, a townhome development, anything like that, the profits are treated as normal income or active income if it's held in a corporation.
Good.
So I'll just touch on quickly our U.S. portfolio. Again, here's a bit of a snapshot. In the top left is our Elser Hotel and Residences in Miami. The top left and the top middle are actually completed buildings that we have. They're not renderings. They just have the benefit of nice Florida weather to make nice pictures. So those are our 2 completed assets. We're in the midst right now of selling out. We're about 60 or 70% sold on the Elser Hotel and Residences. That was one where we actually started the project as a multifamily development. So it was I think about a 500 unit purpose-built rental. And sort of to my earlier point about being the equity and the owners behind the project, we found ourselves in a bit of a lucky situation where we finished the building about late last year, and early last year. So just before prices and construction costs were running up significantly. And this is also when Miami was kind of really in the midst of a bit of a hyper growth phase. So we had sort of talked to the local brokers and those in the market in Miami, and really essentially for those that were coming or looking to buy in Miami at this time, there's really no other competing product, right? We're the only finished high amenity building on the waterfront in Miami. So if someone's looking to buy a new build, it was really just our product. So we made a bit of a decision and said, okay, our risk is behind us. We've already incurred a construction cost. We don't have any exposure to any cost inflation from here forward. We ran the numbers, and it turned out that if we were to switch this to a condo rather than a multifamily development, it wasn't slightly more profitable. It was significantly more profitable. Even after there were some tax consequences triggered, the net effect of that was investors were still in a much better position than under the original multifamily plan. So we went through that process, basically canceled any leases that we had outstanding, provided compensation to all the tenants that had signed. They hadn't yet moved in, but we wanted to provide them compensation as well. And then went through a sales program. And as I said, we're about 60% of the way sold through there. And that one will be likely wrapped up by either late this year or into Q1 next year. The one in the middle is the sort of the first multifamily development that we did in Fort Lauderdale. Sold that about a year and a half ago. It was the largest single asset sale in Fort Lauderdale's history, about 260 million, I think it was. The bottom left and the bottom middle are 2 others that are in progress right now. A similar project in the Wynwood area of Miami and one in Denver. And the bottom right is the Waldorf Astoria. As I mentioned, it's the ultra luxury condo. So we're in the midst there. We just started construction last year, so it'll be probably about 3 years away from having that completed. But again, our focus in the US, like I said, it's kind of a dual focus on sort of ultra luxury product and then multifamily developments. The sort of the little G pins are markets that we're currently active in. Little other dots are ones that we're looking at for future acquisitions. So whether it's Tampa or St. Pete or Sarasota, Florida, Dallas, Charlotte, North Carolina, those are markets that we kind of look at. Not really your New Yorks or your LAs of the country. More so these sort of cities that have a lot of strong economic trends behind them, strong population growth, high quality of living. In the case of Florida, no state income tax, so you can see why people are kind of flocking there in droves. But that really is sort of our thesis and where we focus our efforts in the U.S. And again, the multifamily projects that we do there are really centered around Class A developments, so highly amenitized, massive oversized gyms, on-site food and beverage. Some of that would be rent by the bedroom as well, where you have maybe 30 to 50% of the property might be these kind of co-living, where people would do individual leases for a room. Really, it allows them to kind of come in with a smaller rental price, but from a per square foot perspective, which is what we're more interested in, a higher per square foot revenue for the building. So that's really what we're looking at. And it's sort of these well-located urban areas as well. And it's essentially, we're doing it under what we call our Society Living banner. So that's kind of our partnership, our brand, alongside Property Markets Group. And again, it's the quality of amenities and the way that you would engage with the buildings in these markets really kind of puts anything that you would see in Toronto to shame. You have your whole building can run off an app, so you can get notified when you have parcel deliveries. You can book amenity spaces with that. Chuck, if you want to come by for a weekend, I can send you a digital key on your phone. After 48 hours, I can turn it off so that you can't commit anymore. So it's really, that's kind of the focus there, kind of hitting that, young professional market that's not really looking to buy per se, but looking to rent in a very kind of highly amenitized, engaging building. Our value add strategy, as I mentioned, it's a bit of a different focus for us. It's I would say a smaller portion of our projects. Really, that's driven by the fact that these assets are kind of hard to find. Shouldn't say hard to find. They trade frequently, but hard to find at what we would say is an appropriate price, where we feel comfortable coming in and not overpaying per se for these, because really the goal here is to take them through a repositioning program where you're bringing the rents up to market. They might be below market today, upgrading the common areas, the hallways, the amenity spaces, improving the efficiencies and heating and mechanical systems, really to take a portfolio that might be generating, let's say, $1 million in net income annually, and to grow that to, let's say, $2 million in net income in a 4 to 5 year window. And then from there, sell the property, generate a capital gain to our investors. Again, you'll have, in some cases as well, quarterly income because it's an actively tenanted building, and then move on. So these are all ones that we do, but again, it's a smaller portion of our overall activity. And again, I won't sort of walk through too much of this, but suffice it to say, it's really just kind of modernizing what are typically 20, 30, 40-year-old assets that were probably underinvested or neglected from their former owners. And I'll just talk a little bit about sort of investing with us and sort of how the projects work. As I mentioned, the typical project, will have about 80 to 85% of the equity that's needed for the development will be raised through that Greybrook limited partnership. The balance would be contributed by our developer partner that we're working with. Together, we would then own a project or through a JV partnership. Essentially, that's sort of the capitalization or how the equity is raised going into a development. From that point forward, Greybrook is responsible for any kind of deal structuring, reporting to our investors. So you'll have access to a Greybrook investor portal where you can log in, view your projects, view your unitholder reports, any tax slips if applicable. You'll have our team you'll have a dedicated investment rep as well. And their developer partner is the one that's responsible for the actual day-to-day execution, the ones that are responsible for procuring any construction financing, for putting up any corporate guarantees required to help support that. So that on the way out, essentially when we're finished the project, it's typically that the profits are split generally in a 45-45-10 fashion. So 45% to the investors, 45% to our developer partner, and 10% to Greybrook. So essentially, as a firm, that's really how we earn the bulk of our profits and our revenues as a firm is on a success fee basis when projects in our portfolio finish up. Not really interested in co-managing developments for free for many years. So it's just really to make sure that everyone's motivations, whether it's our investors, ourselves as a firm, and our developers, that we're all, everybody's properly aligned in their incentives. So,
so Barry, question for you. I mean, obviously, having this kind of silo structure where you would invest, per project is different than, let's say, like a real estate investment trust, or sometimes like the syndicate mortgages where it's like that, it's a larger portfolio. So what do you see as kind of the advantages and disadvantages of the way that you do it, and maybe even how it lines up with the other options in the market?
Sure. So I'd say it's a good question, because we get the question occasionally from clients, like, why don't we, just have a fund where I could just, give you $100,000 and get instant diversification. So I'd say depending on your preferences, some might see that as a drawback. I think what we've seen, really, real estate's a very tangible asset, right? I think people like to know, what am I investing in, right? If it was a blind fund, you would have no idea where we're putting your capital, whether it's in all high-rise projects, all low-rise developments, everything in like Arizona or whatnot. With a project-by-project basis, you actually get to see every development that we're doing, right? You get to see the project plan, who the developer partner is, what the associated timelines are, the return profile. Granted, it might take some time. So if you wanted to allocate, $100,000, $200,000, whatever that number is, again, our goal is always to diversify that for our clients. So it might take, a few months to get that fully invested. So again, you can look at that as a drawback or a negative. But I think what we found, almost unanimously across our client base, is that they like being able to make those decisions and say, what, don't like this market, or I don't like this project type, or maybe this one's too long for my time horizon. Again, so there's certain, not every product's appropriate for every client, right? And that's why we have, a client manager, an investment rep for every client, so they can build that portfolio together. They can look at, Chuck, what did you currently invest in? You've got a condo development in downtown Toronto. Okay, our next one's very similar. It's the same partner. Maybe it's a bit different. So sure, you can do it, but you're not going to get a whole degree of diversification. So you have that advice component as well. So yeah, I think there's pros and cons, as you mentioned, Chuck, but I think, even though it might take some time, which is generally the biggest con, I think at the end of the day, when you're investing with a 5, 6, 7 year horizon on average, if it takes a few months to get that portfolio properly invested, then it's probably better in the long run.
Good. Yeah, I think so. The client manager, the investment rep that you mentioned, the team that's involved, would they ever advise you? I know you talked about 5, 10, or 15% of the household investments. Do you cap that? Do you say, okay, look, maybe Greybrook should not be 50% of your portfolio? Like, how does the advice work with something?
Yeah, like that? I would say outside of like our staff and our management, for the average investor, we're not designed to be someone's primary investment strategy, right? Much of that, like you mentioned, Chuck, it might be 5, 10, maybe 25% of a portfolio, and that really ties back to the fact that they're multi-year investments. They're illiquid, right? Which is a big feature that people need to bear in mind. It's much different than investing your money into a stock or a mutual fund or an ETF, where you can just, if I want out tomorrow, I can just wait till the market opens, click the sell button, and I'm good. With our projects, you're invested for the duration of the development. So bear that in mind. And really, I think in a weird way, COVID was kind of the perfect illustration as to why we've always had this restriction, because people's income situation or their financial assets change quite rapidly, unfortunately. And we really just don't want people to be in a position where, because they've invested 60 or 70% of their liquidity with us into illiquid investments, now they're in a bit of a financial jam, right? So we always just want to make sure that investors maintain access to other liquidity or liquid assets outside of us, which is why there is, for every investor, eventually a cap, right? It really depends on the profile of the household, the income, the financial assets. It's not really a black and white, number, but that's why we go through a know your client process. We're regulated by the Ontario Securities Commission, so we don't want to ensure that people are just qualified to invest, which is obviously an important part of it, but also that it's a suitable investment for them, right? Given their time horizon, given their risk tolerance, given their liquidity needs. That's why we go through, a client, I know your client profile as part of the first step with investing with us.
Good. So an estate question, if somebody were to invest and then before the timeline is up, they happen to pass away, that's handled just by the estate, so it carries forward?
That's right. Yeah, being in business now for 20 years is not like we've had these many times, unfortunately. So really, it wouldn't change anything in terms of it doesn't trigger a payout or a liquidation. Essentially, it just depends on how you've invested. So, Chuck, if it's in your TFSA and you've specified your wife as a beneficiary or whatnot on the account, then it would just be transferred, to her TFSA or however you've sort of designated in your estate plan. So they are transferable under those situations, right? So yeah, it really kind of depends on how a client's invested. If it's a registered plan, typically when you open the account, you have the option to specify a beneficiary, which is usually the most sort of simplified way of doing that. Otherwise, it would just be handled however you've sort of specified in your will or your estate plan.
Okay, I've got two more questions and then maybe we'll just kind of keep it rolling. So the first question is from Hussein in the chat. It says, which government organization regulates this investment? So you mentioned it's the OSC.
That's right.
And then
the Ontario Securities Commission. Yeah, we're registered with every provincial regulator across the country. Why we don't have one federal one, I don't know. Whether it's the Alberta Securities Commission, BC, the AMF in Quebec. So all the requisite financial regulators in Canada we're registered with. I'm also one of the few reps at Greybrook that's dually licensed, so I'm registered in the US as well with the SEC and FINRA. But they're essentially our regulatory body that oversees us.
Okay, so
we go through OSD audits on a fairly regular basis as part of that. Okay,
so maybe I'll pop in another question. So are there any fees from Greybrook to us as directly as investors? So I guess that's kind of baked into the total investment. As you said it, actually, you receive a 10% at the end as an institution of Greybrook.
Yeah, so that's the profit split, or what we call the success fee. And when an investor invests, they'll get an investor presentation. They'll also get an offering memorandum. So the offering memorandum describes, it's not as friendly to read because it's really written from a legal perspective, but it gives a lot of detail on the partnership, on our partners, on the project. It also details the certain fees that are in the project. I'll give you an example. We have sort of two vehicles in a project. We have the limited partnership where our investors invest into, and then we also have the joint venture nominee company that actually operates the project. Both of those vehicles are audited each year. So whether it's PwC or MNP or KPMG, will typically have a number of audit firms that we work with. We have to budget and capitalize for 4, 5, 6 years of audit fees within a partnership. Things like that are what we call our offering and maintenance fees, and they're specified in the OM for a project. And then Greybrook Securities, basically as part of our capital raising efforts, receives a placement fee from whichever partnership we're raising capital for. So I would equate that to really that's kind of the operating revenues for the firm. Again, the bulk of our revenues on a long-term basis come from that back end. They really kind of significantly dwarf what we kind of earn at the outset.
Right. So if I had $25,000 to invest, let's say, are you saying there's going to be fees above that, or it's all included within that?
It's included within that. Yeah.
Yeah.
So you would have, if you invest $25,000, you'd have a $25,000 investment. Your book value, your cost base is under $25,000. And whenever you look at a presentation from us or a unit holder report, or if you log into your investor portal and you see what the portfolio looks like in terms of returns, those are all net of fees. So it's not, 100% ROI over 5 years minus, 10% in fees. That's already accounted for in every one of our return figures.
Okay, so last question, then I'll let you keep going, is what level of risk would you say this kind of investment is? This is from Olivia in the chat.
Yeah, we would typically sort of rank, I would say, in a medium risk level. So not low risk from our perspective. Like the way that we would interpret a low risk investment is if someone says, I want no chance of loss for my capital. Maybe I've historically invested in GICs or government or provincial bonds where you're not really have any principal at risk, you're probably going to get a bit of nominal growth. On the other end of the spectrum, it's not risky, like I would say cryptocurrency or like small cap mining stocks, where it's much more speculative, right? Again, ultimately at the end of the day, when we're raising capital, it's going to purchase real estate, right? It's going to buy actually physical lands, right? So we have that true asset that's owned by the partnership. There is always a chance that depending on how the market goes, or if you're forced to sell the lands and you sold them for less than you paid for, sure, there is the possibility for capital loss to investors, which is why we would consider ourselves medium risk. Having said that, I think with the benefit of carefully underwriting over 20 years, we've managed to avoid that scenario. But yeah, hopefully that answers the question as to kind of where it would fit sort of in the risk spectrum.
Well, it's just, if you really believe in the future of this GTA market and any other market that you choose to invest in, like, you can just see that this is a generational problem of, like you said, there's massive constraints to supply, and there's demand. I mean, all those things that you look at from a fundamental perspective, it's hard to imagine that this is going to go any other way but up.
If anybody was familiar with what happened in Las Vegas, I'll kind of pick on that market for a second. Sort of back in 2008 in the financial crisis, there was really very few constraints to developers to come in a market like that, right? It's much more like a straightforward permitting process to get going. And when the market was hot in kind of 06 and 07, there was such an oversupply and buildup on homes there that once the market kind of crashed in late 2007, 2008, it took them 14 years to kind of chew through that inventory and get back to where they were, right? You didn't see that really happen in Toronto. Not to say it's impossible, but like I said, the industry for a long time hasn't been able to kind of meet the demand by new growth, new household formation, and there is that sort of more fundamental basis than other markets. Like, again, I feel like I'm picking on Vegas, but that's one that we had done a bit of analysis on just to see what they did and how they kind of fared through that. And it was when you don't have those fundamentals and there's really no barriers to entry per se, you can get into an oversupplied situation that can linger for a long time, right? Which is why, again, we choose our markets carefully and like to kind of stick to what we think, at least in Canada, in the GTA and the Greater Golden Horseshoe, has the best sort of long-term underpinning.
I have a real estate agent friend of mine in Las Vegas, actually. In 2008, he said that the builders were offering 2-for-1, buy one house, get one free. And there were people refusing them because they didn't want to pay the taxes on the second house.
Yeah.
So
don't think you see that happen in Toronto.
Like, I'm going to refuse this free house. They don't want it, right?
Yeah.
Wild.
It's an extreme example, but for sure that goes to show you why market selection is sort of step one, right? Get that correct, and then move on to picking your partners carefully, underwriting your lands on appropriate assumptions, and then going from there.
Well, we always say in our investor class, like, you win on the buy, not the sell, right?
That's right. Very good way to put it.
Yeah.
So I think I'm pretty close to, as I mentioned, a little bit more about sort of our approach with customizing portfolios for investors. As I mentioned, you'll have access to a Greybrook investor portal, so you can log in, see everything that you have at your fingertips, and you kind of unitholder reports. But again, that's not meant to replace your team at Greybrook. It's really more of a self-serve option. In this day and age, everybody needs to be able to kind of log in and see their investments in a very concise and easy to look manner. So that's why we have that. And actually, that sort of brings me to the end. So we can sort of walk through any more questions if there are, Chuck.
Yeah, I've been crossing off some of the ones that came in. But so let's say somebody wanted to invest. It's $25,000 in one shot. Is there installments? Or like, what kind of deadlines? I know you just launched a project in Hamilton, for example. Right. Like, what are the expectations for a project maybe that's on the go?
Yeah, good question. So typically, from the time we release a project to our investors to when sort of funds and your subscription documents are due, it's usually about 8 weeks, give or take. Sometimes even a little bit less, sometimes a bit more time. But that's kind of the general cadence with the new offering. The question in terms of investment amounts, so $25,000 is the minimum. So it's a standard minimum for any project. It's not increments of 25, so it's really any $100 increment thereafter. So if somebody had, 33,500 in their TFSA or whatever, and they wanted to do that, perfectly fine. And in terms of timing of investment, so we do kind of one capital raise at the outset, a bit different than other, private equity investments where you could have capital calls, where as you get a year into your project, 2 years in, you could say, okay, Chuck, now the project needs more equity. Your share is, 10,000 more. There are no capital calls under our structure. So if a project ever need additional funds, so if let's say we get approval for more density, which is great because now you can build a bigger building and it's more profitable. The flip side is your budget's also larger, so you would need more equity opposite your lenders. In a situation like that, we couldn't say, okay, now we have to raise more capital from our investors. That obligation actually rests on our developers' shoulders, right? So again, going back to why it's important to work with top tier developers that can write a check for $5 million or $10 million if necessary. Just to clarify, and it's a really good question. So there are no ongoing requirements from our investors. So whatever you've invested at the outset, that's the most that you can ever be essentially called upon.
I have a question from Gabby. So she asked, do investors get an opportunity to buy units at the development that they're active investors in?
Yeah, great question. We do. So once we go through the planning process for our projects and get ready to do a public sales launch, we'll hold a Greybrook Friends and Family event. So you'll have essentially first access to whatever specific condo unit or lot in a low-rise development. So a lot of our investors over time have really looked at this as a chance to kind of pick up an actual physical unit in the projects, whether it's for the kids or for investment purposes. So it's a good question, and yeah, that is a perk that we offer. I mean, we can't really sell through the whole project. At an event like that, we have to kind of balance that perk with also trying to maximize the profitability of the project, because as you go through subsequent releases, you'll typically push pricing on your product as you go through. But it is a program that we offer for our clients.
Great. Stephen has a question. He said, what and when is the next project? So I think you've whet people's appetites. I don't know if you have anything. This is a webinar that's designed to be a little more evergreen, that'll last over time. But as of middle of May 2023, is there anything you want to share with the people on the webinar about what you have or what's coming up?
Sure. Yeah, so we'll typically do. I mean, this is sort of the $1 million question that I get quite often, is like, how many products will you do per year, or what's next? And we'll typically do between 5 to 10 per year. Again, it's hard to plan that. It's really a function of the pipeline and how many opportunities kind of check all the boxes from our perspective. I think from here through year end, I would guess probably another 3 or 4 projects. As I mentioned, Chuck, we just had one that we launched in Hamilton about 2 weeks ago. It's sold out since. So if anybody's from Hamilton or had heard of that, it had a really good response. We're looking at a couple developments, two potentially in the U.S., in the South Florida market, one potentially in Atlanta as well. And there's 2 others that are also, I would say, high in the probability list in the GTA. So we're looking at a condo development likely mid to late summer in Toronto, in the Etobicoke area, along the Bloor subway line, and also a couple other low-rise sites that we're looking at. So those ones were probably still in the 7th or 8th inning of our underwriting, so they may not come through. But I would say the best process is really just to kind of reach out to our team. If you're interested, we can have a deeper discussion offline, and then once you kind of go through that investor profile, that sort of know your client process, then you're basically going to be on the list from our perspective to see new opportunities as they come out.
Good. Julie asked, what's the average project length? So I believe you said 4 to 7 years.
Four to 7 years. Yeah, I think it just given the size and the scale of the developments, like really, 3.5 or 4 years is probably the shortest realistically that we'll do. I would say 5 to 6 is probably the most common. The Hamilton one that you saw, Chuck, is about 7 to 10 years. And that's just a function of, being a very early stage project where we have to go through, in our opinion, about 3 to 4 years of planning work before we get into selling, 1,000 plus homes and a 150-acre site. So it's probably not the best example of of duration. We'll have some like this that are long-term projects, but most of them would be in that sort of 4 to 7 year bucket.
Good. Rose asked a question about, do you have any examples with numbers specifically for any projects? I think that might go beyond the scope of this webinar, but
sure.
Is that something you might even be able to share if somebody reached out to you individually then?
For sure. Yeah, I mean, I think some of these questions are probably best handled sort of directly with our team.
Okay.
But I would say, as I mentioned earlier, our target is generally being able to hit about a 20% kind of average annual return. And I think if we look at our portfolio, in the last 20 years, our actual exited performance has been pretty accurately around that figure. Granted, you'll have some that might be underperforming, whether it's due to a project going a bit longer or costs going up a bit more than forecast. And then, as you mentioned earlier, there was also some that are materially outperforming on the high end. But I think if somebody approaches it and builds a portfolio that's properly diversified, it should approximate what our targets are at a portfolio level.
Good. Now, somebody had a question about that's compounded, right? So at the end of 4 to 7 years, it's the 20% compounded that you could expect.
It's not compounded, so it's just a simple kind of average annual return. Okay. Yeah. So if you were to do a 5-year project with 100% return on investment, it'd be about 20% kind of simple average annual
Gotcha.
return.
Okay, so great. I think this is a great question. Nicola asked. So she said, I've had a couple of pre-construction projects that have terminated. So she's invested in projects. So is there potential of that happening with investing with Greybrook?
Yeah, I imagine she's probably referencing like a canceled project or.
Yeah, exactly. Like I've come to the sales office, give my deposit, and I find out years later that the developer has gone under, or they're bankrupt, or whatever it is.
For sure. Yeah, I mean it's possible in any development. I think it's in any case where that's usually happened. It's more, and I don't want to paint with a really broad brush, but it's usually either you have a developer that might have been a bit inexperienced, right? They might have thought, in their opinion, that I'm 2 months away from getting my planning approvals, and I can jump into a hot market now and launch sales. And then it turns out they're actually 2 years away because they don't know how to navigate the intricacies of planning in our markets. And what they've done is they've locked in 2021 pricing, and now they're paying 2023 costs, right? And essentially their margin and their project becomes eroded to such a point where it's not financeable, right? Because when you have a construction loan, or when you're looking to procure a construction loan, the lenders will typically require a certain return on cost, a certain minimum level of margin. And in those cases where projects get terminated, more often than not, it's just that their costs have gotten away from them, or they've not properly structured themselves in the acquisition, and now they're becoming not a financeable project. So their only option is to really kind of unwind the project, and in most cases they're probably selling the lands, probably still earning some kind of return in that exit. But if you look at the developers that we work with, I mean, these are firms that, in the case of Tribute Communities, have been around for 40 years, right? Fieldgate Homes even longer. The reputational risk of doing that for a lot of our partners is, probably the last thing that they would ever want to contemplate doing. So I think for sure, given the way that the developments work, it's possible, but again, not with us. I mean, I shouldn't say not with us, not happened. I don't want to generalize, but I think in those cases, like Nicola might have encountered, probably a combination of factors that happen there.
Yeah, I mean, as you pulled up that list on the screen, I was like, I've had excellent experiences with all of them, and I've never heard of any projects for a single name that I saw on that list that has ever run into trouble.
That's right, and that's why I think ultimately the greatest level of diligence that we'll do is really honestly on our partners and who we work with. Right, you could have somebody who's tied down the best piece of land in downtown Toronto, and you might approach us and say, hey, what do you want to work together on the site? And if it's a developer that is working on their first project or has no background to them, or no track record, no strong banking relationships, that's a pass from our perspective, right? They probably could do quite well if they hit it well in their execution, but that execution risk is just too unquantifiable for us, right? So that's why we have kind of our vetted list of partners, and we put a lot of effort and time to kind of aligning our organizations, working well together, and the benefit that we bring too is that we kind of sit at an interesting point in the ecosystem where, we're not just one developer with one pipeline. We have access to a dozen developers and their pipelines and their, activity in their portfolio. So a lot of information that we kind of bring to bear that helps kind of improve on the performance of our projects.
Great. So I think we'll end off first of all. The Leafs, 45% of you think that they're going to they're going to win. So I don't know if anyone's watching the score, but we'll be respectful of everyone's time. We're about an hour in here. So last thing I'll ask you, Barry, is just before we wrap up is, let's say somebody wanted to take the next step. They wanted to have a conversation. They wanted to potentially invest with Greybrook. What do they do after watching this?
Sure. So you can reach out to me directly if you wanted to. I think you saw my email up on the screen, or Chuck, maybe you can share it as well. Or even info@greybrook.com. You can check out our website, greybrook.com. There's a contact us link on there as well. Let them know that you just heard about us through the the webinar that we did this evening. And then we'll be able to set up a time to sort of coordinate, go through any more specific questions that anybody has. Again, as you mentioned, Chuck, it's really just, the purpose of today was just to get a bit of a general overview. There's a lot of questions that individuals might have about, strategy, about their situation that are best addressed directly with our team.
Great. Can you put your information up? Like, is there a slide that shows that?
Yep. Sorry, I'll share my screen again here and throw that up there. There we go.
And just a clarification from so the slide of property developers, Hussein, watch that on the replay. We'll make sure we post up the replay. And then the Sean has a question about exit strategy. Are there any penalties for early withdrawal? It sounds like you just can't. It's not liquid.
That's right. Yeah. Right. There are extenuating circumstances where if somebody's in financial distress, or you're going through a divorce. Not to kind of get too dour, but there are some times where people need to find liquidity, and in that case, we can try and find a buyer for them. I wouldn't really count on that. It's done on a best efforts basis. And there is no sort of standard early redemption option. So again, that really kind of ties back to why we have certain limits on how much people can invest. So just, when you're deciding to invest in a project or a certain, duration of a project, just be mindful. And I would kind of go in with a mindset that I'm investing in it for at least this number of years.
Okay, super. So I think we'll wrap up. Barry's information is there on the replay. When we post that on the page, we'll also put all of his information too, and just let him know that you heard about it through this webinar. And I want to thank you very, very much. I want to thank everyone who attended. I think this has been very enlightening, very exciting, and I look forward to a good future together. Perfect. Thanks for your time, Chuck. Thanks everyone for joining. Great. Thanks, Barry. Thanks, everyone. Take care.